Thank you for the introduction and thank you for the opportunity to come with all of you and thank you for your time. Appreciate it. So today is part one of a three-session series. And today we're going to go over some investment options that we have, the basics. The next session on the following Wednesday is going to be about protecting what you've built. So we're going to cover insurance and protecting yourself from scams and also from your own self. And we'll talk more about that today. And the last session is going to be about creating a steady retirement paycheck. And I'll go over some very specific strategies that I use with my clients. So today we're going to cover investing in retirement, the basic building blocks. And I didn't want to assume, but I kind of assumed that it's going to be a mixed audience, people that have a good understanding of what investments are, but also people that may not know everything. So starting at the basics, but then we go a little high level. And then we talk about risks in investing. And I've introduced some of the strategies that I like. And there will be time for Q&A at the end, but please interrupt me if you have any questions. Like, don't wait until the end because it's hard to concentrate when you have like this burning question. That's true. Yeah. And this is me. So I'm a first generation immigrant. I moved to the United States in 2004 for a graduate degree in electrical engineering. And all of my education in India, I think my parents spent about $5,000 on everything until my bachelor's degree. And then there was like this, rude awakening that education here costs so much. And I was very fortunate because even though I come from a very humble middle class background, my parents, especially my father, did something that I advised my clients against. He gave me his retirement savings so I could pursue my American dream. And
does that mean that you're supposed to take care of them when they get?
Yes. Yes, I'm their social.
What?
Yes, so they invested in me,
Especially if they have more children.
And they live with me for the most part. So I have a multi-generational house. I have my own practice. It's called Wealthwiser LLC, where I help retirees and pre-retirees, like people who are on path to retirement, understand their finances and make better financial decisions. I'm very passionate about personal finance. So I started after my electrical engineering degree. I worked in the field for a while and then got an MBA and then moved to managing institutional finances. So I managed a large investment portfolio upwards of $800 million for Amica Insurance. And that's when I started getting a lot of questions about what should I invest in and people making bad decisions, investing in Bitcoin and all of that. And so I started my YouTube channel to educate people about, the basics of finance. But I also made a lot of mistakes when I had no idea what I was doing. So in my first tech job, they gave me a 401k. I had no idea what it was. And I asked my fellow co-workers who had PhDs. So 3 years that I worked in finance, in tech, my bad decisions, like this year, the cost of those bad decisions came up to around $300,000. And if I, assume a certain rate of return on those, by the time I retire, it's going to be $1.2 million. And at this point, no matter what I do, I cannot make that 1.2 million back. There's nothing I can do at this point that will, redeem me from those mistakes. But that has motivated me enough to make better decisions going forward, but also educate people on how to avoid some certain pitfalls. And this is not rocket science. So with that, let's start. But I want to give you this disclaimer. I am a financial advisor, but I'm not your financial advisor. So anything that I say or present today is without regard to your personal financial goals, circumstances, or constraints. And this is only for education purposes. So use this information and make your own decisions or seek guidance. So investing in retirement, unlike investing when you are in your earning years, is not about chasing returns. It's not about it's about security and that reliability. So let's talk about investing purpose. And anyone care to share what your purpose is in retirement? See what you're trying to generate or what you're trying to achieve. No wrong answers.
Well, for me, it's a sense of financial security. Having to worry, particularly if health issues, I think that's the biggest fear.
How expensive it can be.
Right. I mean, so being able to handle that, because I think it's not dependable anymore what I can or can't count on. So that independence and that security is the big thing that drives my concern.
What I have in, well, my wife and I have in investments, we just have there for the kids. So our goal really is to protect what's there and to responsibly grow it.
Well, I was thinking along the lines of Doug. I see more and more spouses that are widowed and or even worse is when the other spouse requires a lot of care, and it's unbelievable how much that care costs per month. You think putting kids through college is expensive. People, you could easily spend your life savings in a year of specialty care. So my concern is twofold. It's a little bit that, but it's a little bit more that because my husband is older than me, and his retirement income will go away once he dies. And I'm going, time for a roommate.
So along the same lines, like there are three major things that I hear from people that I work with. One is generating that income, the steady income, because your paycheck has stopped. So you can pay your bills and your regular expenses. But then there are also emergencies. So anything that comes up and you want to make sure that the capital that you have accumulated over the years, you have that and preserve that. And then finally growth, because like Lynn, you suggested, uncertainties. There is longevity risk, or there can be sickness, and you don't know how long your portfolio has to last. You don't want to outlive your savings. And then there is this big thing, the inflation. So in 1918, with 18 cents, you could buy a quart of milk. And then 50 years later, your purchasing power is reduced by half. And then the next 50 years, it's reduced to 1/3, and that's going to continue. So inflation is, sort of killing your existing savings. So if you don't make investments wisely, you're not going to have enough to live on. So let's talk about the basic building blocks of investments. There are stocks and bonds. So let's say I start a company and let me come to you, Rob. Rob, can I have $100,000? I'm starting a business.
No.
Yes.
Ask my wife first.
So yes, that no is a perfectly good answer, or you could use some other choice words, which I won't use. So, but another option, like you could use a 5-word answer, which is what's in it for me? Okay. And so I could promise you, like you give me $100,000, and at the end of the year or in 1 year, I will pay you back your $100,000 plus $1,000. How does that sound?
No.
So, what about 10% on the 100,000?
We're getting there.
Okay. So at some point we may agree, okay? And what I did there is I sold you a bond that you give me money, and then at the end of a specified term, I pay your money back with interest. So that's like the simplest bond. So that's that. Like purchase date, the buyer gives money to the issuer. So this is me, and you are the buyer. And then at maturity, I pay you back the money plus interest. And you can structure it, any number, in different ways. So if you know, like, and trust me, you may be willing to accept a lower interest rate. But if you perceive me as a high risk company, you will demand a higher rate of interest. Okay. Any questions?
And the interest rate can't change though once the transaction happens.
No. So it may, depending on how the deal is structured. So in the simplest case, it won't. So if we write our papers and the note says that this is the interest, that's the interest. We cannot change it later on. But then there are floating rates as well. Like you may have seen in mortgages. So those rates can change. And so we talked about the interest and the maturity. So the long, typically, yes.
Would I also be at risk of losing my 100,000?
Yes. So if I am a prudent company and I make good decisions, then you like I said, no like and trust.
Right.
Then the risk is low. But if I start picking fights with the president or two other things, the risk goes high. And then you would demand a higher rate from me. So there are different types of bonds, okay? Like when as a company, I sold you a bond, I sold you a corporate bond. But if the government sells you a bond, like the US government selling a bond, that's a treasury bond up there. And then if other countries, like other governments sell you bonds, those are called sovereign bonds. And then there are agency bonds like Fannie Mae, Freddie Mac. They selling you these bonds, and those are called agency bonds. Then there are municipal bonds, so the US treasuries, they are like backed by the full faith and credit of the United States government, and they're considered to be the safest of all. And others may not be as safe, right? So for a bond with a maturity of a year, Treasury will probably pay like the lowest rate compared to some other riskier entities. Then municipal bonds are also backed by government, but they're backed by local governments like municipalities. And what they do is they use the money, like proceeds that come in for different projects, like building a bridge or, taking care of roads and whatnot. And even though they are government, like local government bonds, they are not safe. So they are like often misunderstood. What happens with municipal bonds is that they are tax exempt at the federal level. So you don't pay any taxes on the income that municipal bonds produce.
About a state level.
Yeah, though similar. Yeah. Then they can be classified by maturity. So short term is typically anywhere from 0 to 2 years. Intermediate is between 2 to 10 years. And then long term is anything beyond 10 years. And then by rating, so there are three major agencies that rate individual bonds. So there is SLP, Moody's, and Fitch. And then they have different systems in which they rate bonds. Anything above a triple B plus is considered investment grade. And anything below that is called high yield or a junk bond. And those pay higher rate, but there is risk of default.
So I get emails all the time from the banks that I do business with, suggest, wanting me to buy bonds. This is a good time to buy a bond. So are they just selling the bond at the same price that I would get if I went directly to the government, or do they put a fee on top, or how does that work?
Depends on the brokerage. With treasuries, it's very nominal. Most brokerages won't even charge a commission, but with other bonds, there is a spread.
Oh.
So there is, and by spread I mean like if you were to buy a bond and at the same time sell a bond, buying the same bond would be slightly more expensive than what you would get when you sell the same bond. So the difference is what the brokerage.
Oh.
Then you have interest rates. So you asked me about like whether the rate is. Did you have a question?
Well, we weren't sure we hadn't understood that.
Think about like if you were selling your car to the dealer, you
agree on the price.
you agree on a price. So let's say I agree to buy your car for $3,000.
And if they bought it from me for 25, then they'll keep the 5.
Right.
Yeah. And then like if you come back to me and you say that I want to buy the car back, then I hike the price of the
Yeah, so
and then that's the money that I keep. So that's what the brokerage does.
Real quick, is floating rate the same as variable?
Yes.
Okay.
Yes. Yeah. So fixed rate is fixed no matter what happens. Like my company does really well, you're still going to get the same fixed rate. That's the rate.
is floating based on like the cost of living index, or
It may be based on the interest rates that the Fed sets,
okay.
or it could be based on. So there is so banks lend and borrow money from each other. And it's called the LIBOR. So that's like an overnight rate. So sometimes it's based on that.
So then does that mean it's better to buy when interest rates are low and they're starting to get more, so that you want to put that get a floating one?
If you are receiving interest, then perhaps yes. But think about it from the point of the issuer, right? Like as a buyer, you are investing or you are buying a bond because you want a certain interest back. What is my motivation as the issuer? What do I want?
You want it the cheapest possible.
Well, you want to
Yes.
be able to use that money.
Yeah, I want to be able to use that money, but I want to keep my costs low. As a corporation, I'm not motivated to give you more money. My intent is to keep my interest expense as low as possible. So if interest goes up, I would rather keep your money. I mean, I have to give it back at maturity, but I'd rather not give your money back before maturity. But what I can do, like when we are drawing out this agreement, what I can do is I can make the bond callable. And by callable, I mean that I can give your money back and then I can refinance the bond at a lower price. So if you've ever tried to purchase a bond on through your brokerage, you will see two yields. One is called the yield to maturity or YTM. And the other one is the yield to worst. So which is the yield you would get if the bond gets called.
So you still make money on it, but you wouldn't have gotten the full amount.
Full amount, right, exactly. So
But then you have the money to get another.
you could get another, but at a lower interest rate because interest rates have gone down. So yeah, by probability. So a couple of years ago, when interest rates were super high and people were buying CDs through their brokerage accounts, and people would like always ask me, "Oh, is this looks like a great CD? There's a very high rate, high yield on it." And I'm like, look at whether the CD is callable. Because if it is, then you as the investor are taking on additional risk.
Yeah.
Because the CD issuer can return your money. You get your money, but like a lower one. And then you are at risk of like reinvesting that money at a lower rate. So you don't lock in that rate.
That's interesting. That's not complicated.
Before you leave that slide, the listing by issuer, is that meant to be in order of increasing risk? Or
Not
it's just
necessarily.
coincidental?
Yeah.
Doesn't have anything to do with that?
Yeah, no. Muni is like people think that they are not risky, they can be super like high.
Oh yeah, look how many cities have gone broke.
Yeah.
You said S&P,
that's
your bonds.
So they rate bonds.
They rate.
The rating agency.
It's a rate.
Okay. Oh, I see. They're the ones who give it like the triple B plus or
Yes.
higher rating. Okay.
Exactly. And they are the ones who rated all these in the great financial crisis of 2008. They have given high ratings to a lot of these, junk bonds as well.
So if they learn their lessons, you think they're more dependable now?
And weren't there some laws that came in play?
Yeah, absolutely. Yeah, but like there was, I don't think anybody was held personally liable.
No.
Nobody went to jail. And that would be like a big deterrent, right? Okay. So what's the second way I can deal with this? So instead of selling you a bond for my company, I could say, hey, Lynn, want to buy a piece of my company? And for the same amount, like 100,000. So
What do I get out of it?
you get a piece of the company. So now any profits that my company generates, you are a shareholder now. So anytime I make a big sale, I can choose to give a percentage of my profit to you as a dividend.
Wouldn't I want to know how many other stockholders there were?
Yeah, so in case of a public company, a lot of this information is publicly available. So public companies in the US, they are required to file certain forms. So there is 10K, which is issued annually. And it will list a lot of the information that you wouldn't find on a private company. And so yes, similar transaction, the buyer pays money. So this is pre-IPO, okay? This is before the company has gone public, but you can always buy shares of the company on an exchange after it goes public. And so now if the company beats expectations and it does better than what people predicted it to do, the size of the company grows. And the per share value will grow. So at that point, the owner can sell their shares to another buyer and make a profit, or they can continue to hold it. And certain companies can choose to share their profits as dividends, if you've heard, if you're familiar with them. And others decide that they are growing and they need money to grow, so they are not going to share dividends. So they keep reinvesting in the company until they reach like a plateau or a steady state, and at that point they will start sharing dividends. The company disappoints, the company shrinks, and your per share value goes down. And then at that point, you can continue to own it at a loss, or you can sell it at a loss. Okay. Go ahead.
I've had that.
So, this is how stocks can be classified. So, first one is by market cap. So, there can be like large cap companies with a certain threshold, and then mid cap, small cap, micro cap. Or you can categorize them by sector. So, technology, healthcare, and there are like I think 10 or 11 different classifications. And then within each sector, there can be different industries. And then they can be classified by geography, domestic markets, developed markets, emerging markets, frontier markets. And then by style. So, like I said before, if the company is growing too fast, like Nvidia or Tesla, they're probably not paying dividends. And most companies start that way. They are in their growth phase, they are not paying dividends. And then eventually they may become value. So at that point, they're paying dividends. There are some other criteria. Yes.
Can you explain market cap? I'm sure I understand.
Okay, so market cap is like the size of the company. So at the most basic level, it's the total number of shares that the company has. So all these individual pieces multiplied by the price per share. And so that determines the total value of the company. So that's market cap.
And so if you just have the lower levels,
Yeah.
they have fewer shares.
No, they may have they may have the same number of shares,
Yep.
but each share is priced at a lower.
Okay.
So overall, it's a smaller company.
And eventually those prices per square go up.
Yeah.
Hopefully. I used to do Disney stock. I wish I still did.
So every stock that you own is like owning somebody's business, and you partake in both the reward and the risk. Because let's say you own some share and the company goes bankrupt, you are not getting anything. Bondholders get a precedence over stockholders, which is why the yield or the reward is capped. You don't get anything beyond it. And then there are covenants to a bond. So there may be like some restrictions placed on what the company can and cannot do with the bond. So let's talk about risks. So stocks have market risk. Let's say I make widgets, but the demand for widgets goes down. So that's a risk, right? For me as a company. There can be business risk. I become fine for the president and my shares can go down. Economic risks. There are tariffs. I rely on China for my raw material, and the prices, because of tariffs now, my costs are going to go up. So now I'm at a risk. There can be liquidity risk. So usually like larger companies like Apple, Google, they trade like millions of shares each day. So if you own a stock of Google and you want to sell it for liquidity, you can log into your brokerage and sell it like in less than a second. But if it's a smaller company and there aren't many buyers and sellers, it's hard for you to sell your shares. So liquidity is a risk with some of the smaller companies. If you've looked at like some penny stocks, that people like send out these scamming emails telling you to buy something and it costs like 10 cents. So those are the stocks that are at risk. And then there are emotional risks. And we'll go more into those. You have a questionnaire that you can fill out. But those are things that you do as an investor. If the market goes down and then all of a sudden you are scared and you could like just sell your position. So that's an emotional risk.
Oh, I have a question. I wanted to back up to what I think you said about bondholders get precedence over stockholders.
Yes.
So does that mean a company might issue stocks as well as bonds? Or it may only issue strictly stocks and not bonds, and maybe the other way around? So, and if that company folded, the bondholders would get precedence on getting whatever they could get over stockholders. So if I, as an investor, I'm looking at a company, I guess it's in their description or whatever you want to call it, that they've issued both stocks and bonds. So that's something as an investor you should look at.
Not necessarily. Like, just know that this happens, but like if the company holds, right? What do they own? Do they own IP, like intellectual property? Do they own tables and chairs? Like, what are they going to liquidate to pay back? So it's not a good out. Like, you probably should not be invested in a company at risk of holding. Yeah.
Like, I know, where's that Ouija board?
So like a company like AT&T or IBM, they've got bonds and they've got shares of stock. They're a pretty robust company. You
Yeah.
wouldn't worry about it, what the mix is, and if for some reason they're trying to raise cash, they're selling bonds, they might have a good interest rate. Maybe go after the bonds if you're looking for that.
I didn't know that companies sold bonds. I thought they owned stocks.
Yeah. And I mean, it's just like municipalities, like they want to do something. They need some cash.
Yeah.
It's a good way to raise cash, particularly if they have all their cash deployed, doing other things to do something. But then,
Maybe
if it's a
form should open up a bond.
but if it's a small company or, and that's where like, that's kind of low or small caps are a little bit more risky potentially.
Yes.
But the reward is potentially higher because they can grow faster, right? The capital is not going to grow a whole lot.
Yes.
It's already
Drawn. Yeah. Right.
right. But somebody with the next iPhone that's starting out looks like it's pretty cool, but really potentially take off. So that's why
Potentially. But potentially.
that could go the way of let's say Microsoft had a phone, right? Zoom or something like that.
Well, they did have.
That was it, right?
They had a quite fast. Yeah.
So there are many factors that you don't know about a company, right? Like we went over all these market risks. Let's say I like a company, like ABC Co, and they're the greatest company in the world, and they're doing really well, and I invest. But what I don't know is if there is an XYZ Co that's operating out of their garage and they are producing something that is going to surpass ABC.
What happens if ABC decides to split?
I was just gonna say that because I had
I had
Motorola
that
stock
happen
years
with
ago.
Disney stock. They split it and then it was worth less.
It's not worth this. It's the
It's not
exact.
worth, it's just worth less. And now.
Worth less than the second one.
Yeah, so like, let's say you own one share of Disney,
Mhm.
because they split, so let's say they split into two.
Yeah.
Then instead of owning one share, you would own two
Two.
shares. And if they were trading at $100 before the split, now you have two shares trading 50 each. So your worth is still the same. So splits don't really affect anything. The primary reason companies split is to make shares affordable for
More people.
because nobody,
Hopefully push it stock up.
yeah,
Well, it does eventually.
yes. And
I have a question that goes back a couple of statements ago. How large, let's say, Chesapeake Forum decides they want to go public.
Okay.
How large does a company have to be before it can go public?
it's not about how large you have to be.
But I mean, as far as investments,
Uh,
is there?
I don't think there is a cap as such, as long as you're able to convince investors that this is a great value, then you're fine. So the whole IPO process, it's like there's a lot of marketing involved because you involve investment bankers. And there are multiple investment banks, but the top ones only take companies that.
Sure.
There's another sure. Yeah.
Yes. And then they charge you, like, they would charge Chesapeake Forum a lot of money for IPO.
Breathtaking fees.
Yeah.
Yeah.
If investment bankers take out of a deal, the fees are breathtaking. And
Yes.
they're huge. And by the time you pay, well, there may not be any minimum size for what it would require to go through an IPO. You're gonna have to have enough to pay the investment bankers and the lawyers.
Right.
And
Yeah,
that's
okay.
millions upon millions upon millions of dollars. Okay, so
Yes.
so those transaction costs, you have to be big enough so that the transaction costs are not gonna be a material hit on your business.
And you also lose control, a certain amount of control of your business. That's why so many stay private.
But depending on how you structure the IPO,
Yeah.
you can do it so that you retain control if you're selling 49%.
Yeah.
Okay.
But there is a lot more oversight for public companies because you have to submit a lot of different and with investment banks, they also take on some risk, big risk. They buy your shares upfront and then they go and sell it to all these institutions, right? Insurance companies, pension funds, other like foundations and so on. So they're doing the
Yeah, I
market.
can tell you, so from personal experience, I worked for a company and it was a telecommunications company. It was just before the dot bust, when we built that way too much fiber optic. And CD&R, which was a pretty big investment, they bought us and they were gonna plan to take us public. They ended up losing, at the time, it was the largest loss. They lost almost $1 billion on us because the bust came. We went from doing $1.4 billion in sales, doing 300 million. We laid off about 3/5 of our employees. I mean, it was a disaster. They lost their.
Is that when the vodka shares went so high?
Yeah. It was awful. It's nothing like going to a bankruptcy.
Yeah.
Also, I've done some research on what companies do after IPO, and I cannot remember the exact numbers, but like it was more than 80% of the companies lose value after IPO. So I personally don't prefer to buy at an or pre-IPO. It's like, let me settle and then enter the market. And okay, so we talked about stocks and
Can you be sure everybody understands what the letters IPO stand for?
oh, IPO is initial public offering. So right now, if I have a company, it's privately held, I'm the owner, and it grows and grows and grows, and I need more and more capital. I can sell shares of my company and grow it, like get money from all you guys, grow it to a point, and then at a certain point, it cannot grow any further without reaching a massive number of people. That's when I would approach an investment banker and go public. So that's that's called the initial public offering. And after it goes public, the shares, instead of you having to come to me to buy shares of my company, they're going to start trading on the exchange, and you can buy shares through your broker. Okay. So stock risks, but bonds are like, even though people find safety in bonds because there is a certain perception that you're going to get your money back, there are risks associated with bonds. So the biggest one is interest rate. So now if you buy a bond and you hold it until maturity, it, like, you know, you're going to get your money back with interest if if the person or the entity is reliable. But if you need cash all of a sudden and you need to sell your bond, based on the interest rate at that point in time, you may lose value. So the value of a bond is inversely proportional to the interest rate. As the rates rise, value of a bond falls, and vice versa. So if you want to sell your existing bond and interest rates have risen, you're going to have a loss. So that's your interest rate risk. If I'm an unreliable issuer, I could default on your bond and you get nothing. So that's your default risk. Then you have your reinvestment risk. So most like longer term bonds, they pay interest periodically. They don't pay like a lump sum at the end. They pay.
Their stocks just dropped.
Say the Navy number there. Let them know we're trying to have. We're concentrating.
Elephant in the next room.
That's the new chart for the day.
So this is reinvestment, is if you had a bond, it paid, now you're gonna get a new bond, and interest rates are gonna be different.
Yeah.
Okay.
Or you get periodic interest, like treasuries pay.
Oh, no, they were pulling a box out of the closet, a big.
Their records, investment records.
Your bond, a treasury bond, pays interest every 6 months. So the amount that you get every 6 months, you can either use it, which is fine, but if you don't have the need for it, you have to reinvest it. Or at the end of the term, the maturity date, you get this lump sum, and now you have to reinvest it. So that's reinvestment risk. Because remember, you started with a certain interest rate at the beginning, and now interest rates have changed. So you have to worry about that. And then, like I mentioned before, callability, right? Like if interest rates drop, I could call the bond and give you your money back. And now you have to worry about reinvestment risk because interest rates have dropped.
And that's really the only reason they call it, is if interest rates drop so they can
Yes.
save money.
Yeah. Or they may have like enough cash from revenue and they don't want to reinvest.
Oh, okay.
So they could just pay. Okay, so now to avoid all these risks, what can you do? You can be in the right place at the right time. Okay. So let's see.
See dial on your phone. First of all, yeah.
So now let's talk about the economic cycle. So every economy goes through a cycle. There is expansion, then it reaches a peak, then there is contraction, it reaches the bottom, and then starts all over again. And depending on where we are in the cycle, different sectors or different types of companies tend to do better. So during an expansion, technology, financials, communication, consumer discretionary, those kinds of things do well. Then at the peak, financials, energy, materials do well. And, healthcare, consumer staples. So consumer staples are typically your anything grocery related, right? You would buy it regardless of what the market is doing.
You gotta pay utility. Okay.
You have to pay with utility. So Campbell soup is an excellent example. During the great financial crisis, people couldn't afford anything, so they were eating soup, and Campbell went through the roof. And then recovery, you have real estate industry. So any guesses where we are in the economic cycle? Okay. And no wrong answers.
Just thinking about it.
We're after a peak.
Yeah.
Going down, okay. Okay, any other thoughts?
No, because real estate right? How fast does that cycle go? Because
Nobody knows.
Yeah, because real estate is pretty high. It's gone up.
2008 went down real quick.
But right now, it's up pretty high. The average is also almost enormous now. So I was thinking maybe we're getting expansion. What?
It's cheap here compared to California.
No, I was thinking national figures.
Yeah.
So I'm guessing that we're moving towards expansion.
Okay, and
That was because there's a housing shortage and it's just supply and demand.
Yeah.
Well, I mean, that's the other thing, right, that can affect it, right? Irregardless of the economic cycle, if there's a shortage, right, that can push.
Well, yeah, and it's becoming more
Right.
expensive to get the products to build
Mhm.
for any company. So I don't know. What do you think?
no, I don't know either.
Oh.
So you could all be right or you could all be wrong. And nobody has a crystal ball. And the way I've shown this cycle, it has like a very regular pattern. That's not true of economic cycles. You can have a really long expansion and a short contraction or vice versa. Nobody knows. And the way these data points are determined is they look at several economic factors, which are often at a lag. So you won't know where you are until after the fact.
Yeah, so if you're looking at stocks and you're saying, oh, look, real estate stocks have been doing real well, you might buy them, but you might be at the end of when they're going to do well.
Exactly. So you could be buying at a wrong time, you could be selling at a wrong time. And so the solution to that is to be everywhere at all times instead of trying to pick and choose.
So have technology stocks and financial and healthcare and real estate or whatever.
Exactly.
Is there any balance on those that you should have as you're older and as you're in your 80s and that kind of thing?
Yes,
Yeah.
depends. It depends on a number of factors, and we'll get there with the
Like risk tolerance.
yes,
Yeah.
that's one factor. But yes, there is a certain allocation that can be recommended.
What is an ETF?
So ETF is an exchange traded fund, and mutual fund is it's a combination of a number of different. It could be stocks, bonds, a combination of both. It could be some other asset classes. So what a mutual fund can do, so instead of having to buy all these different stocks in technology and consumer discretionary and energy and real estate, you could go and buy a mutual fund. So mutual fund and ETFs are pretty similar. They're both a collection of different stocks or bonds. The difference is that, like a significant difference is that to buy a mutual funds typically trade only once a day at the end of the day price. So when you go and you click buy in your brokerage, you won't know what price you're getting until the end of the day, for whatever the 4 p.m. price is. With an ETF, they trade light stocks, so their price changes throughout the day, and you can buy it anytime during the day.
So. Since the mutual fund has an underlying value of the stocks of the portfolio,
Yes.
but if an ETF trades like a stock, it is the buyers and sellers' perception of the value of the portfolio of stocks that ETF holds.
Correct. Yes.
Okay.
But
Do they
it's
track pretty closely?
yes. But if the underlying stocks are liquid, and by liquid I mean they trade often, then they track pretty closely.
Okay, but if an ETF is in a pool of less traded or
Yeah,
less
it could.
liquid stocks, then it could, the ETF's value could vary from the underlying.
Yes.
Okay.
Other things that are different between those two besides just when you can buy and sell.
Oh.
Yeah.
There is one significant difference which is related to your taxes. So mutual funds, whether you make any trade in the mutual fund, periodically the fund distributes capital gains out to you. So you buy a mutual fund and you hold it, but somebody else, some other owner of the mutual fund may be buying and selling. And based on the total accumulations, the fund has to distribute those gains out to you. And so you get a 1099 at the end of the year, and you have to pay taxes if you hold your mutual fund in a taxable account. If you hold it in an IRA or 401k or Roth, then you don't have to. But that's like another major difference.
But there are different fee structures for mutual funds, right?
Yes, yes, yes. But before that, like not all mutual funds or ETFs are created equal. Just because it is a mutual fund, it may not be diversified. There are really concentrated mutual funds that focus on a specific sector or a specific industry, and like some may hold like 10 different names. So pay attention if you are investing in mutual funds for that broad diversification, and pay attention to what the underlying assets are. And then there are actively managed funds and passively managed funds. So with passive funds, they track an index. Like they could track the S&P 500, which represents the largest 500 companies in the United States. Or there could be a fund manager making active decisions on, oh, do I want Google in the fund? Do I want Tesla? Do I want British Petroleum? So they could be making active decisions. And based on whether the fund is active versus passive, the fees are different, very different.
Could you comment also on the difference between load funds and no load funds? In addition to talking about the differences in annual expense ratios between active and index funds?
Yes. So loads are basically charges that the fund levies on the capital, and there can be front load funds. So let's say you invest in a fund with a load of 5%, front load 5%, and you invest $100. Right off the top, the fund gets to keep $5 and only invests $95 in the fund. And then it invested, and whatever happens to it happens. And then after some point, you decide you want to withdraw your money. They can charge back end load. And let's say your fund again grows to $100, they charge a back end load of 2%, they keep $2, you get $98. So all these loads and annual expenses, they are a way to like reduce your money. So you, at best, you want to keep all expenses low, but at a minimum, avoid funds that have loads. Yes.
It may be worth noting that among the active funds, you talked about how the 80% of IPOs lose money. And 80% of the more than 80% of the actively managed funds do not do as well as the passively managed index funds.
Why is that?
Yes.
Right?
Yes. Good point.
Why is that?
Actually, it's more than that.
Okay, so you go back to that ups and downs and per inch
And
into
they're
the
trying
nose.
to
And they guess and they guess wrong. So they lose money, plus they're taking out a lot of money to pay high paid
people who are
asset
actively
management.
managing the
Right.
fund.
Yes.
And don't some of the mutual funds also, besides stocks, don't some of them also invest in bonds? Same.
Yeah, they can. And all of that is defined in the prospectus. So they are not fleecing you. They are not committing fraud. All of like the strategy, how they are going to draw their fees out, everything is listed in like this 100, 200 page long prospectus,
Yeah.
which is meant to confuse you, but it's all there.
And be a lawyer.
Now, if it has loads, it doesn't have.
It's listed. So there is a fact sheet, like a summary sheet that lists it.
It's not 200 pages.
No, that's a shorter one, but then the details are in the prospectus.
Basically, if you buy through a broker, you buy a mutual fund through a broker, any broker, you're gonna be buying a load fund,
Okay.
almost invariably. So because the broker takes its
That's how
commission
they get their.
out of that 5%, if you talked about
Yeah.
that. So you invest $100, there's a 6% commission that goes to the stockbroker.
Yeah.
So you end up, at the beginning of the day, you put in $100, at the end of the day, you have $94 left.
So does that mean that they make more money the more often they move you from one?
Yeah.
Yes, based on that. Yeah, the only person who ever made any money off of my investment with a broker was a broker. Right? Because the brokers made a lot of money, and I didn't make any. So,
And then there are these 12B1 fees, which are like marketing fees. So what they use those for is to create these beautiful prospectuses and go around marketing the fund. So you are paying them to essentially like market the fund to other investors. Do you want?
So, but to the point about seeing the load fees and 12, right, you can go online and there are places where they will lay out all those things for you, so you can see that. And of course, just like if you're gonna have something done in your house, right, you get free quotes. You should look at different mutual funds and compare them and see. And you'll, after you start looking at a couple, you start to see the patterns and what to look for and the things that we're going to hear to watch for.
Like Yahoo Finance or Morningstar. So if you just Google the name of the fund, you should be able to, in the first few links, see like the summary page that lists the all this important.
and the annual expense ratio as well can
Yes.
vary widely between the actively managed funds and the fund and the index funds.
Most definitely.
Yeah.
So to your earlier point about how actively managed funds underperform. So when I was working for Dominica, I had access to a lot of different research. And what I came across was that in the US, the median actively or active manager underperforms the broad index. So they underperform the S&P 500. And not just like there are some that do outperform, but there is no consistency. So 1 year they may be at the 90th percentile, and the next year they could be at the 5th percentile. And so then the question becomes, are you charging for skill or are you charging for luck? And I refuse to pay for luck because that can go away. Now in international markets, there is some evidence that active managers they could outperform. And some of it, like in Europe, for example, if you largely avoided bank, you were good, you outperformed the index. Or China, if you avoided like the state-owned companies, you were good. But international managers also tend to charge higher fees than domestic ones. So when I was with Amica, as an institutional manager, I could negotiate fees. So where retail investors were paying upwards of 1%, we were paying like 0.35%. So that's and it like we could justify investing in those for 0.35%, but for 1% I would probably do.
I have a question. Regards to some of the ads on TV, when a company says we are fiduciary, so we're protecting our salesmen from taking advantage of you.
Oh, yeah, I hear that.
Yeah, can you explain that a little bit for those of us who don't quite understand that?
So fiduciary is a term used that like we are acting in your best interest at all times. But even in so the non-fiduciary, like there are two kinds of advisors. One is a fee-based advisor, which sounds like okay, it's fine, and then the other one is fee-only advisor, which is what I am. Fee-based advisors can sell you products like insurance or annuities
Or load funds.
or loan funds, and then they get paid commission from the organization that they work for, represent, or have a relationship with. So fee based, like it's confusing, but that's what it means. That it's not always in your best interest. If a product is going to pay me a higher commission, I'm going to recommend that to you instead of this other product that is better for you. Okay, so that's like the fiduciary, non-fiduciary. But even on the fee only side, there is a lot of nuances, a lot of different kinds of advisors. So most traditional advisors, they charge you a percentage of assets under management. So if you've heard of the term AUM, so they would charge a percentage of how much they manage. And as your assets grow, then the fees grow, right? Like with assets.
Even if you're losing money.
It's a percentage of what they have. And then there are like flat fee or advice only or project based advisors that won't do that. Okay, so let's talk. Yeah.
I'm still confused on the difference between mutual fund and ETFs from, you mentioned taxation.
Yeah.
But I didn't actually understand the difference.
Okay, so at the basic level, let's say I am a fund manager, and I decide to create a fund with the top 500 companies in the US, so as the S&P 500 companies. And you can now buy this fund from me. So if I'm a mutual fund, I give you permission to only trade once a day at the end of the day. Okay, so that's a mutual fund. I can also restructure this or create like another fund, which is the exchange traded fund. Now, instead of buying it from me, you can buy it through the exchange, just like you would buy a stock. And then this exchange traded fund trades throughout the day. So 9:30 to 4, anytime you could go on your brokerage website, and you would know exactly the price that you're getting. Now, to buy the mutual fund from me, you would have to send in your order before market close. So, before 4 o'clock. But you won't know the price until after. So the following day when you log into your account, you would know what price it traded at.
Right, but as far as taxation, you mentioned difference.
Yes, so taxation. So because for mutual funds, I have to if you decide to buy and then Doug decides to buy and Cindy buys and Rob buys, now I have to create additional units of this fund. Okay, it's not trading on the exchange. I have to create more shares. Okay, and now suddenly, like Doug says, I want to sell my share because I found a better investing opportunity. So I'm going to sell, and then commensurately, all your shares kind of go down. So I kind of generate some capital gains in the fund. Now, as a manager, I don't want to deal with capital gains. I don't want to pay taxes on it. So I'm going to pass those on to you. So I'm going to just return your capital, and then you get to pay tax on that amount. So now, if you hold the fund in a tax exempt or a tax deferred account like an IRA or a 401k or a Roth IRA, you don't have to worry about it because it's tax deferred. But if you hold it in a brokerage, I'm going to send you a 1099. What is it? 1099 worry. No, 1099. I think it's a worry. The one is the debt. Yeah, but I'll send you that form, and then you get to pay taxes on what I'm distributed on.
Right.
Okay, so the S&P 500 Vanguard.
But it's taxes at the capital gains rate, at the federal level.
Capital gain tax.
Yes, it's a long-term capital gain.
So it's 18% effectively.
Yeah,
15,
yeah,
18.
depends. 15, 20.
Instead of 40.
But does that mean you have to hold that mutual fund for a certain period of time for it to?
Well, assuming that you held it for 6 months. In other words, as a long-term capital gain, it's a short-term capital gain.
They're, at the end of the day, they're very simple. They're almost identical. There's a slight tax consequence. It's never very significant. On mutual funds, I have most of my stuff is in mutual funds because I don't know what to trade on. And yeah, you get hit with some capital gains.
And there may be a small difference in annual expense ratio
Right.
of like 0.02% or something.
So it's
For index fund. Yeah.
Trina has a question.
If I use an app like Robinhood or Fidelity, is that only ETFs?
I don't know about Robinhood specifically, but like I don't use Robinhood. I should ask Abhishek. Robinhood. But like Vanguard or other Merrill, you could
I'm just thinking it's so easy to do it.
you could trade mutual funds.
Oh, you can't, okay. I thought they only dealt with ETFs just because of the speed of it.
Yeah, let me check on that. Get back.
Yeah, I know Fidelity is both.
Yeah.
Mutual funds or ETFs.
Okay.
Just that mutual fund, like you said, you don't know exactly the price you're going to pay. If the stock market was to go, you do the trade, and then the stock market in the afternoon is to go way down,
Yeah.
then you would get less
Don't let Trump
expected.
say anything dirty.
Versus if it's an ETF, you know exactly what it is. I don't know if there's any questions on that.
Oh yeah.
I'm keeping an eye on that.
Okay. Sometimes just ask if anybody else.
Yes, Mike and Monica, if you have any questions, please let me know. I'm sorry, I'm not like really paying attention to the screen. They both muted. Okay, so let's talk about fees. You good? Okay. So actually, let me lay it out first. So let's assume that you just retired with $1 million portfolio. How are we doing on time? Are we okay?
Give it 15 minutes.
50. So let's say you retire with $1 million, and you plan to draw 4% each year, and it's going to be based on the end of year balance. Okay, and you have two.
Don't just told her the time. She's looking around.
Yes, for the back.
She has something.
And now let's say you have two investment options. And for simplicity, we're going to assume that both investment options generate 7% year over year. One fund, like the one option, charges 1% in fees. The other option charges 0.08%, so much lower than. So let's see what the impact of fees is on your portfolio. So the yellow bar shows the 1% fund, and the green bar shows the 0.08% fund.
Shows how much we have left after they take their fees.
Exactly. Yes, and the growth too. So in the first decade, the difference is about 128,000, 129,000. So about 10% of your portfolio is lost to fees. In the next decade, you have 18% or 305,000 lost to fees. In the third decade, about 500, about 500,000 lost to fees or 25%. So 1/4 of your portfolio gone. And longevity is high now. So fourth decade, after 40 years, like 30, where is the, okay, there it is. 32% or almost $1 million lost to fees. So if you can take only one thing from today's presentation, this is what I want you to take. Fees can be huge. And like I said before, active managers typically charge high, passive funds don't charge as much. But then again, active funds, like you kind of, because they underperform the market, you're paying them to basically underperform.
I know you would think if you would think that an actively managed fund would do better, so you'd make up the difference in the fee, but that's not the case.
Most often not.
Yeah, well, that's a misnomer for those of us who are green on the.
It's all gonna change their jobs.
Peter Lynch.
I haven't really looked at this very.
Not recent,
Okay.
but back in the day, Peter Lynch, he was the phenomenal stock picker, but he was really unique. And he had a really long run
Meaning he hasn't.
of beating the SP, but like he's at home. And so
And there was this guy at T. Rowe Price, he managed the life science fund. So, but he was really focused on that one sector, life sciences. He had a very strong track record. He left and he started his own fund. I haven't really followed him. But then again, like I was just going to buy one sector, or do you want to be everywhere? Like as in,
The 1% is considered high, but some of them charge more than that.
so for my clients, I typically like I highlight anything over 25 basis points, which is 0.25%.
1.25%.
Yeah, one would charge 2-3%,
Yeah,
which is outrageous.
and that's
But
fine.
imagine if you would take this chart and you figure that 2 or 3%, and you can multiply it orders of magnitude
Yeah.
larger than what you're losing.
I don't even know what mine's being charged, but I know that it's not doing as well as what I hear other people say, so.
Well, and it's interesting because we're with Edward Jones, which everybody says charges so many fees, but we've made so much more money with them in the last 7 years than with an individual, well, it was a family-owned business, but basically they just, it was just charged by trade.
Yeah.
But we were with them for
But you could compare
years, we
between
weren't
the two,
taking
and
any,
that's-
and we were hardly made any money. So I'm like, okay, we're paying the fees, but we're also making a lot more money because a company like that, they've just got a whole slew of people that are just
Yeah.
following the market. That is tough to decide.
So that's your homework. Look at what you paid.
I should take a picture.
Oh, I shared the presentation.
Sharing.
Yeah, I'm sending you the PDF.
I have it.
You have,
Yeah,
yeah.
I can send it out. She gave it to me as a PDF.
So we'll to take a few minutes to do that quiz that you have on your. It's a short one, just 12 questions. Yeah, I think while you do it, I can talk about your scores. So do you have your scores? Have you added?
Oh, no.
Yeah.
I added up to 30. That's it. I have even much lower.
Lynn, do you have any ideas why this says I'm sharing, but I'm not?
Does it have to be moved?
No, I have. So if I hit share,
Anybody agree?
You can choose.
Can you slide it over to the screen?
no, because I have it set up as duplicate. It's worked this whole time.
Yeah.
Why? Why it changed?
Me too.
That's why Korean does this. Darn system changed their name.
That's fine. So let's look at the scores. If you score between 12 and 18 points, you are leaning conservative towards your investment. Between 19 and 29, it's moderate. And 30 and 36, you are an aggressive investor.
Gosh, I'm not kidding. I'm barely.
So the willingness, so this quiz just shows the willingness to take risks. But there are two additional components to your risk tolerance.
What's up now?
Yeah, that was my stupidity. I pulled out the cord so that I could search for the document.
That's one of the points. But then there are three components, right?
It's only viewing one from you.
Oh, thanks.
So the risk tolerance is basically your willingness to take risk. The next component is the need for risk. So what are your objectives, through the next 10, 20, 30, 40 years? And based on that, you can determine whether you need to take additional risk. So for example, if you're going to live to 100 years or 105, 10 years, you want to travel celebrity, you want to take expensive vacations, then you have a higher need of risk because you want to make sure that your portfolio, you don't outlive your portfolio. And then also risk capacity. So somebody who has a large portfolio, but they're only spending a small portion each year, they have a higher capacity. So think about those aspects. Now we talk about different assets or different investment options that are available and the risk and return profile of each one. So the vertical axis shows the historical average return for each of these data points. Like each point represents an asset class. And as you go higher, historically those assets have generated higher returns. And as you go from left to right, these assets have higher risk. So typically that's the case, right? Higher return, higher risk.
So you want to hold on to them longer.
Typically, like for higher risk, higher assets you hold on. And that's what each dot represents. So if you look at this bottom one over here, that's cash. So that's like no return, no risk, except there is a risk. There is risk of inflation because you keep your money and you lose your buying power, you don't invest. And then you have your savings accounts, CDs, then you have your treasury bills, and then this section here is mostly bonds. There is alternatives, which is your venture capital, private equity, and those kinds of investments. And then most of these are stocks. And then you have real estate here. So historically, what has happened is real estate is probably at like a similar level of municipal bonds, but at a much higher risk.
I would have expected a higher return.
Yeah, but this is like an average investment. I'm sure you're able to find specific real estate deals that would generate higher and better returns.
Where would gold fall into that?
So gold would be in
Oh,
commodities.
commodities, okay.
So commodities include any like oil, pork bellies,
Minerals, thing.
minerals.
It's appeared to high risk.
It could, yeah. I mean, the data shows that.
And you think about gold's kind of an emotional buy. Right? Right now,
Gold-
people are
plus
buying
gold
gold.
could become it's a standard now, but maybe it won't be sometime in the future. So, well, no, oil is the standard. For you. Interesting.
Sitting.
Yeah.
Please now.
Everything's going down. Buy gold. Be
That's
safe.
exactly when gold went up. When
Yeah.
Thank you.
And these are some of the retirement income strategies, and we'll talk more about this in the third.
We should be talking about pension funds too.
Funds, we'll talk about pension, yeah, and how to operate them. And yeah, so there is systematic withdrawal, like if you set a certain rate of withdrawal, like 4%, and withdraw that same amount. Then there is dynamic withdrawal. If the market is up, you withdraw more. If the market is down, you don't withdraw as much. And then the bucket strategy is what I typically use with my clients. So we'll go into the detail in third session. But most people I work with, they love the reliability of the bucket strategy.
I didn't mean pension. I meant annuities.
Oh, we'll talk about it in the next session.
Really.
Mhm.
Okay, so homework. This is the last slide. Determine your need for this. Any questions?
Thank you so much.
Very good.
Yeah, that's right.
There's a lot to bury in my brain.
Thank you for coming all the way here from Ellicott City.
Of course, yeah.
You can reach out if you have any questions, want to discuss anything.
Or if you just go to Ellicott City, we.
Actually.